There's a company that raised $300 million last week in the US. It's called Etched, ETCHED. Ever heard of it?
No.
Probably Val might be $3 billion. Just came out of stealth mode.
Yep.
I'm going to tell you what they do because it is a very amazing insight.
Oh, these are the guys who etch onto the GPUs or something like that.
No.
Oh, okay.
But the insight in this is how different AI is going to be in 5 years' time from a commercial point of view compared to where it is today and how hard it is to predict how it's going to play out. So I'll just tell you, this is a company where I'm just going to say what you would never have heard of the people involved in it. I'm just going to tell you one or two things that each of them has done or a few of them have done. So one of the founders, a few of them are Harvard Thiel Fellows, which means Peter Thiel paid them to leave Harvard.
Yep. Or leave any university. You don't have to be Harvard.
Yep, correct. A few of them were Maths 55 alumni, which is like the hardest maths course at Harvard where everyone basically drops out.
MIT or Harvard?
You could be right. It could be MIT. I thought it was Harvard. But and so the world maths champions, et cetera, et cetera. So there's a lot of that stuff going
smart
on.
Smart guys, girls.
Yeah, very smart. Okay, this is more interesting. One of them was the co-founder of a business that went to $100 billion and another business that was bought by Crimson Education.
Oh, really?
Bit of a dodgy.
Wonder how they're going, those guys. Well, they're not dodgy. We just question the valuation.
Yeah. One of them was the ex-CTO of another business that was acquired for $10 billion and has shipped 5 systems generating greater than $1 billion in revenue. Now, see if you know what this means. All on A0 silicon. Do you know what A0 silicon means? Do you know what A0 silicon? This is something to look out for. So when you make silicon chips, the first one you make is called A0 and then it's called A1, A2, maybe B1. A0 is the first one you ship, and generally people will expect that it will have some flaws in the architecture and you'll have to make an A1. And so if you say, I shipped A0 silicon, that means you're so good at chip architecture, you didn't have to make an A1.
Yeah.
You could ship the A0. This guy says, I've shipped 5 systems generating more than $1 billion revenue, all on A0 silicon. That's impressive. Another guy led platform engineering teams across Nvidia and built
How many founders does this thing have?
This is the VP of platform. I'm just reading you some of the background of these guys. Built the HGX and DGX systems from scratch at Nvidia. Just know that's like core platforms. Another guy led 0 to 1 production and supply chain ramps. So that's the first stage for 24 products, including the original iPhone, MacBook Air, Pixel, and Chromebook. That's impressive. Another one was on the architecture team at NVIDIA of the H100, A100, V100 and won a Qualcomm Research Award. They're pretty good, these guys.
Yeah.
One built the TPU software team version 1 to 5 at Google. So that's the TPU chips at Google. And led research for Project Astra at DeepMind. So this is the kind of nature of these people. What they are building, and the reason they got so much money is this. And this is why I say God knows where this is going to all go. They have built, so the way that AI works is it uses a software architecture called transformers. And when NVIDIA builds one of their chips, the chip is a multi-purpose chip. It can do stuff that uses transformers, but it can do other stuff as well, like make images, which a lot of that is not transformer-based, or do computer vision. And as you know, it has this software called CUDA, which basically helps the chip know how it should be used. But because the chip is trying to work out what it should be doing at all times, like there's some latency, some time that it takes to figure that out. And then you've got like Google is releasing chips like the TPU, which are much better for inference. So that is like answering questions,
Using
not training.
AI, not
using
training
AI.
Yep.
But even that can do lots of different things. So there is some latency.
And Amazon's doing that as well.
And Amazon has an inference chip and they've got Trainium for training.
Yep.
And I forget what the inference chip called. It's probably a similar kind of name.
Yeah.
But what these guys have done is something, a next step, which is pretty crazy. They've basically said it's possible to encode the transformer logic onto the chip itself.
Yeah, so I was talking about etching it onto the chip.
Is that what you were meaning?
Yeah, exactly.
Okay, all right.
Yeah.
So yes, basically that. But what they're doing is, what it means is all this chip can do is transformer-based calculations, which is a lot of, maybe what we'd call it is anything where you have one token at a time following, which is mostly text-based stuff.
Yeah.
This thing can maybe be 200 times faster than an NVIDIA chip. It can only do that one thing. And one of the challenges is that you have to rewrite the code. Like the main code base that it's in, Like,
CUDA's just Nvidia. So
well, it's not CUDA. It's called.
Well, it can't be CUDA. It's not
It's
Nvidia.
called Tensor RT.
Yeah.
It's something that sits alongside that.
Yeah.
But it's what you program in. Yeah, it's what like you'd program TPU chips in.
Yeah.
So you can't use that. You have to rewrite. So they've just come out of stealth. I think they've raised hundreds of millions of dollars. They have a $1 billion order book already done.
Yeah.
What's interesting about them, and you'll remember this from our AI discussion, is obviously who are they going to use to make their chips? There's only one company you can use to make chips. Really?
not Nvidia.
Nvidia uses them as well.
TSMC. Sorry,
TSMC.
yeah.
But what's interesting is, all of so you have to think about where's the backlog in AI. So the backlog is in two places. One of
Memory,
the places.
right?
Yeah, memory. So it's hard to get memory. And another backlog is getting access to TSMC. It's especially hard to get access to their 3 nanometer production lines.
Two nanos now?
Well, most of the Nvidia chips and advanced chips are 3 nanometer, which of course are not 3 nanometers.
Yeah.
It's just a marketing name.
Yeah.
So this is actually made on 4 nanometers.
Yeah.
So less bottleneck.
Yeah.
Guess who 2 of the investors in this etched company are? If you wanted to get access,
TSMC?
that's one of them.
ASML?
No, because that's upstream. They don't need them.
Yeah.
What's the other bottleneck?
Oh, SK Hynix.
Yeah. So they've got a memory investor and they're going to be able to get access to chips. And the thing is this, if these start rolling...
They almost become like a subsidiary of those two businesses in some ways.
Yeah, I think that guarantees them supply chain, right? And so you have to think about it. No one knows how this is going to play out. But what you now have... So I don't know if you have seen this, but NVIDIA's current share of inference... That means their chips are being used in data centers to actually run AI.
Yeah.
Do you know what their current share is estimated to be?
Obviously, not really much in China because they got blocked recently.
It's still amazingly high.
85.
90%.
Yeah.
And so do you know what the forecast is where they'll drop in the next 10 years?
Maybe they got 80?
So I think it's down to kind of 30.
Oh, is that all they reckon?
Yeah, that's what they think.
That's because Amazon and Google and all that stuff.
And so all of these neo clouds and all of these data centers that are being filled with NVIDIA chips. And so the way you should think about this is that the entire industry is basically sitting on the shoulders of a few hyperscalers. All of the money is coming from these hyperscalers who are under pressure to get returns. And so the hyperscalers pay and then NVIDIA gives them some money that these DC data centers or neo clouds, and then they use that money to buy NVIDIA stuff and Dell stuff. It's all built on this kind of view that this is what the ecosystem is going to look like and the hyperscalers are going to keep spending. No one knows what the world would look like if all of a sudden these chips became 200 times more efficient for doing the bulk of the workload and how that filters through the system. On the plus side...
We speak about Jurassic Park. We spoke about Jurassic Park a few minutes ago. And my favourite line from Jurassic Park, I've talked about it on pod before, but Jeff Goldblum, he was only like 35 or something at the time. I thought he was really old. He had this immortal line where he goes... We're talking about how could these dinosaurs come back to, how could they do what they did? And he goes, life finds a way.
Yeah.
And I was like, technology finds a way.
Yeah.
When something is so high and Jeff Bezos talks about it with your margins, my opportunity. It's the same thing. Like Nvidia is making so much money that ultimately, which is why the share price is under control and the PE is 30, not 100, is because tech finds a way. That margin is everybody else's opportunity.
And interestingly, TSMC, who has a bigger monopoly and more robust monopoly, they don't price to the marginal customer. They basically say we're going to have a fixed margin. Their gross margin is 50%, not Nvidia's 70-something. And that is one of the ways they keep competitors out of the market. They just don't provide enough margin.
They're long-term greedy, not short-term greedy, those guys.
Exactly. And so you have to think about, if let's say these chips rolled out like an etched chip and it became so much more efficient. Number one, everyone who's stacked their data centers with NVIDIA chips, they got problems, right? Number two, it might actually be really good for the models because all of a sudden, effectively Anthropic is struggling to make money because nobody wants to pay the cost of tokens. But all of a sudden, if this was like so much more efficient, suddenly tokens can get a lot cheaper to run.
That's the bet on these things is that unless something like that happens, like OpenAI and Anthropic are dead. So because they're just losing, even Anthropic, which is a much better financial position than OpenAI, almost certainly dies. OpenAI is 100% dead unless something like that happens. So that it feels like all the bets on these, call it the two foundational models, are basically, these two frontier models, are based on something like that, like the input cost dropping. I listen to Ed Citron a lot and he's fantastic and he's constantly saying how these guys are basically insolvent. The whole AI boom was rested on effectively on OpenAI. Without OpenAI, there would have been no AI boom because remember OpenAI started really cranking in, well, GPT was 2023, but even before that, and that's what drove Nvidia. So everything really hinged on this one company that essentially has no business being in business based on current financials.
But then all the hyperscalers. I think the first GPT model was 2020, and then the hyperscalers jumped on. The thing is this that people don't think about. So there's now I don't know if you know this. You might know this. Like there's something like, it's not very big. There's $40 billion or something. It's still small. There's syndicated asset-based finance on chips. And but it's going to grow dramatically, right? And I suspect
when you say on chips in data centers, or I thought it'd be a lot more than that.
Yeah, it's still pretty small.
That doesn't sound right. What about all the private credit?
I think it's just starting to grow
hundreds of billions of dollars in private credit paying for these data centers.
So this is specifically Nvidia's.
Maybe.
Nvidia's lending.
Nvidia. Oh, maybe internal lending.
It's still quite small. Okay.
Yeah.
No, this doesn't include.
What about the blue owls and all that garbage?
Well, this is not including bonds issued by companies. So Oracle issues against themselves.
But there's all these SPVs as well. Off balance sheet. There's off balance sheet stuff as well.
There are.
It's like Enron. It's literally Enron again. This stuff.
Well, the main difference is because I thought about this relative to the subprime crisis, and the difference is the marginal borrower in the subprime crisis was the person least able to pay. It was like the subprime borrower, and then they CDO'd it all up, right? Yeah. So they basically packaged it.
Good and
bad. And it made it look like it was diversified,
yep.
But it wasn't because it was all junk. If you go and get lots of junk and put it together, it doesn't become less junk just because it's diversified. Yeah. Whereas this is a good borrower. This is mostly hyperscalers ultimately borrowing. And by the way, I'm not sure if you know this, but Nvidia has contractually backstopped a minimum final sale price of their chips with a lot of these. That means you can lend money to a neo cloud based on what the final price of the chip is going to be when you sell it on the secondhand market. And Nvidia says if it's below X, we will buy it for X. So Nvidia is effectively using their balance sheet to prop up the
whole AI industry, basically.
But if OpenAI goes broke, probably a whole lot of neo clouds collapse. Because they are the chain reaction that happens, exactly. And this is what you think about. Then the neoclouds collapse. What happens to all of these chips? So they're going to flood onto the market. Absolutely. Now, there might be enough demand to absorb them.
It's not just the chips. It's what happens to the future chips that aren't needed anymore because you've got all these current chips out there.
And so maybe at the moment there's much more demand for chips than supply. But then you have things like etched come along and TPUs. I just think 5 years' time is so unknowable. There's so many.
2 years' time is unknowable. Forget 5 years' time.
It's so hard to pick what's going to happen. And I think this little glimpse into etched, whether they're the winners or not, it just shows
what can happen.
How the assumptions that people are making about this industry, they're changing every week.
We've talked a lot about the Michael Burry notion, the off-balance sheet stuff. So,
well, he's massively short on this stuff.
And I love Michael Burry, but if you look at all the off-balance sheet stuff, so all the hyperscalers essentially put all their spending, they capitalise their spending essentially, on balance sheet, off P&L. So all the off P&L stuff we've talked about. We talk about this all the time.
Can I say this in a slightly different way and then you continue? So investors seem to be able to stomach capital expenditure, CapEx, on AI that matches the free cash flow of a hyperscaler, but they can't stomach CapEx that's more than the free cash flow. And so the problem is, how do you do CapEx, but it's not CapEx? And the answer is you go to a neo cloud and you say, we're going to buy all of this stuff off you on an ongoing basis and upfront a chunk of the money, and that is operating expenditure, OPEX. It's really CapEx that you're just shifting to OPEX so that it doesn't look too bad in your own financial statements. And that's kind of what you're talking about.
Well, we talk about the whole CapEx thing, how people say, if you look at the overall market, the PE multiple is only 22 for the market, overall not that expensive because it's been at 40. And we've said, well, that's not right because a lot of the expense is actually being capitalized. So it's on the balance sheet but on the P&L. So we've talked about it a lot. Everybody knows this. We didn't come up with it, whatever. But there's actually something I hadn't thought of that is. So I was reading Bill Bonner, who's one of my favourite writers. He quoted a guy called Charlie Bilello, who basically said, not only there's something else I didn't even think about, but there's also, and this Charlie guy said, in the first quarter, just 3 companies, Google, Nvidia, and Amazon, saw massive gains in other income category from their private investments in companies like SpaceX and Anthropic. The total of $69 billion in other income was 10% of the S&P's overall net income for the quarter. A percent of this boost, S&P year-on-year earnings growth would have been 15%, well above the 28%. So talking about, we're not expensive because 28%, huge earnings growth. 28% not only has the CapEx stuff, it's also got the investments, the benefit of the CapEx stuff. So
they're marking that up.
Yeah, so the investments in Anthropic and SpaceX essentially was, and now it's come back down, but at the time it was up. That's based on XAI, which was the whole frontier model.
But I'm surprised they can mark that up because the general accounting standard is, unless you're an investment business.
Well, they do in the US.
You hold the investment at cost.
They're marking it up.
Well, that's ridiculous.
So we've got double. So there's 2 reasons why these earnings are just a fraud. It reminds me of 2 things. One was the depression when all these earnings was fake. But we talked about this before, but AOL in 1999, 2000 did the Time Warner deal. AOL had real revenue, and Time Warner did the deal based on real revenue.
Yeah.
Problem is that revenue was all coming from dodgy startups being funded by VC. So the revenue just in 2001 gone. It feels like this could be the same thing again. This is fake. It's real revenue in inverted commas, but it's really fake revenue. It's not actual. It's actually real profitability.
And it's much more. The capital stack in this boom is much more concentrated than it was in the .com boom. It's basically 3 or 4 hyperscalers, and then like some Saudis and a few others, and a few big American banks.
And a lot of debt, which they didn't have in the
and a few American banks lending debt, right?
Well, and private credit. That feels like another whole subprime mortgage thing.
But every time someone comes to the market and says, we need to raise $100 billion from AI, there are not many places that you can get there from. It's much more concentrated than the .com boom was.
Because the dollars are so massive.
Yeah. I mean, I think what you've just described with the markups is like the two of us owning a property, and let's say you own 70% and I own 30%, and you want to be worth more. So you say to me, I'll pay 3 times the value for another 5% from you.
Yeah.
And you mark up your whole 75% now to that 3 times the value.
Yeah.
I mean, nobody would tolerate that.
And not only that, the money I'm going to pay you, I'm going to take off my P&L. I'm going to put it on the balance sheet. So I'm not going to put anything on the P&L. So nothing's going to run through anybody's P&L.
So the question is, I've thought a lot about this. Like, how do you financially position for this moment? And the other complication, which I won't go into a lot of detail now, but at some point we'll talk about this, is like quantum computing is coming.
Yeah.
And probably the hyperscalers, especially Google, they'll be a beneficiary of that. They're building hard on that. And so, and how do you position for all of this? And I think like you can't short AI because you're going to go broke waiting. Like it's unknowable when this thing is going to crash, and there are so many vested interests determined to keep this up, and they're rich, and a whole lot of them are the most valuable companies in the world. So you probably go.
When you think you can't short AI, does that mean you can't short Nvidia? Or because there's plenty of places that Oracle's shortable, SpaceX is shortable. There's lots of stuff that's shortable.
So Nvidia
not investment
is going to survive a crash. It's hard to see how they wouldn't survive, even if
they've survived a few of these. They've had 80% drawdowns. Consistently over their lifetime.
Annual profit and free cash flow? It's like $100 billion or $200 billion. Like,
but it's all based on this fraud, though. Like eventually, this could very quickly unwind.
And so, but even if they started running out of free operating cash pretty quickly, they've got so much cash. Like it's,
I don't think they go bust.
It's hard to imagine them going.
But they could drop 80% like they have.
They could drop 80%, but
and like, back to 2024.
They're vulnerable, but there are much more vulnerable things. So, you could try to pick individual disasters.
Something like Blue Owl.
Well, CoreWeave,
the private credit, the CoreWeaves, the Irons,
that's
lots of
So you
stuff.
think about the stack, right? So you've got the chip. Well, they're probably not going to go broke, okay?
That's Nvidia's the last thing I'd be short, even though I think it might go down 80%, I wouldn't touch it.
And then you've got data centers, and so the more robust data centers are the ones that actually own something, like power, access to power and water and a physical premises. But the neoclouds, as you said, that really own nothing.
Well, Iron is more the first category.
Iron has a facility data center in Texas, and so they could still go to zero. It just means that data center would be an asset they could sell. It doesn't justify their valuation. But CoreWeave has no assets and lots of debt, heavily leveraged. And so you could try to pick them off. You could try to pick off the people that lent to them, which is kind of what you're talking about. That to me is
the more obvious one.
Yeah, and so you say Oracle, but what you really mean is...
No, I think the private credit, Blue Owl's the listed private credit, so that's the really easy one. There's others as well.
You could go and try to short Oracle's credits,
Yep.
like their bonds,
Yep.
if you think they're going to collapse. I think Oracle will find a way to survive.
They've got some really good businesses, Oracle. Obviously,
Yeah.
Oracle itself is a great business. NetSuite's a great business. They've got some actually really good businesses in that business.
But my main issue is this. It's also volatile. The volatility, I was having a look at this on some options. Like the volatility on iron is 30-something%.
Yeah.
Like, I mean, the thing fell 25% in a month. And
Yeah.
these are so volatile. And like, this might stay. I mean, I thought this was going to fall to pieces pretty soon.
Yeah.
But it might last another 3 years.
Yeah.
And so it's kind of hard to know what to do about this. It's an interesting problem to try to figure out economically from an investment point of view of what to do about this and how to protect yourself while taking advantage of the upside.